This is your market rundown for the week of February 13th. And really what we saw last week is the markets moved lower as treasuries moved higher, and really all stemmed from the Friday before. So you can see the employment number came out Friday, February 3rd, and this was a huge surprise to the market. You could see the previous month what employment was at 3.5%, and the market thought the employment rate would come in about 3.6%, but it actually surprised everyone. Really, no one saw this coming in at 3.4. So a much lower and really much better number on the employment rate than what the market thought. However, since the market thought that we were heading to a recession and therefore the Fed would have to cut rates and markets would probably move upward, this was looked at as a negative on the stock market. And you can actually see some of the headlines that came from this. Even Jerome Powell said, because the employment number is so good, they have a much more to go on fighting inflation, raising rate hikes. It was one of the headlines. So it was definitely looked at as a negative by the market. And you can actually see, if I pull up a couple of charts here. So this is the Fed's fund rate. I've shown this before. This green line is the previous projections that the market had for the Fed fund rate. And now you can see this orange line is the new market predictions on the Fed fund rate. So you can now see that the market is predicting that I guess by August, it's going to be right around 5.2%, which previously it was probably about 5.1%. So they're definitely predicting a higher Fed fund rate, higher for longer. So, and this moved up pretty much right after the job report came out. What you're also seeing is so this is S&P 500 earnings, and this orange line is for 2022. So you saw where the earnings were, and then this blue line is where the predictions are for this year, for 2023. You can actually see the market is now predicting lower earnings than last year from the S&P 500. So kind of think about that. You're paying a premium price. Stocks are higher than they were last year, and you're paying that premium price for projected lower forward earnings this year. And if you actually look at this green line, this is for 2024, and you can actually see these earnings projections coming down as well. So the market took this information pretty negatively on the job reports, and it went down. So let me pull up and pull some charts so we can take a look at it. So the S&P 500, we can see, zoom in here. You can see these red days pretty much was up here at its peak and then came down. Now it's obviously rebounding yesterday, but came down last week, and then the Qs, the NASDAQ came down. You can see here's basically where the job report came out, and then you can see just a pretty large down week last week, and of course it rebounded yesterday. So that was last week, and if I start pulling up the treasuries, we can see they're pretty much all breaking out, are breaking down. Treasuries are going up, so therefore the bonds are breaking downward. So this is the 10-year. So we can see it just collapse, and now it's below that little trend right there, this upward trend that it was trading on. And you'll see this on really all the stocks. So this is that was the 20-year. This is the 10-year. Again, same pattern. Here's the peak, and then it broke down significantly, and then here's the trend below it. And then if I go to the 2-year, we can see that as well. Same pattern. And even on the on junk bonds, you would actually see something similar. Depending where you move this line, it's still you can move this out here if you wanted to, because this technically bounced off, but you can see nonetheless a huge drop, even in junk bonds. So this is how all the bonds responded to the job report, sending stocks lower. And really, although stocks did go lower, they didn't go quite as low as maybe I would have expected. And I still think there's a pretty large more room to go down. So we look at this. This is a little hard to see, but this is the Nasdaq, and it's overlaid with the TIP, which is the inflation ETF, inflation bond ETF, and you can see this really trades together. And so usually, for the most part, where you see the TIPs go, you see the Nasdaq goes as well. So they really kind of trade together. If you look here, you see the TIPs going down, but yet the Nasdaq going up and holding pretty well. And so this has created some divergence here. And so you would think one of two things is going to happen: that the TIP's going to go up, which means rates would go down, or inflation goes down, or you see the Nasdaq come down, and they start trading together again. So still some divergence there on stocks and bonds. Nonetheless, today will be a huge day because today is the CPI report comes out. So we can see the CPI, the inflation report comes out, and the market is kind of thinking that the CPI, the inflation, is going to be a little bit higher. You can actually see the Cleveland Fed predictions. You can see for January, you can see it actually has ticked up. Same thing. This is the month over month, and then you have the year. You can actually see that their inflation predictions have gone up, both on the core and the total. And so, which makes sense, because if you start looking at really the different commodities, you can see this. And so gasoline is one of the big ones, and you can see how gasoline went up. Let me try to put this on the monthly. So you can see gasoline going up the month of January. If I were to put a, so you're talking about going up, roughly in between 10-13% for the month. Obviously, it closed a little bit lower, but that's a pretty big percent move in 1 month. Obviously, if gasoline goes up, everything is affected. Everything goes up with it. If you look at copper, and we put this in the month, so we can see copper here going up about 10% in the month of January. Another commodity that just skyrocketed last month. But even things like timber, lumber went up. Let's put this in the month. It keeps going back on me. So we can see this going up, 7.5%. So you've seen commodity prices really jump in the month of January, which, eggs was a big story of how eggs were really expensive last month. So all these things going up in prices is going to hurt inflation. Used car prices went up. So would not be surprised at all if the CPI report comes in this morning hotter than expected. You see the markets make a large move down. Now, the flip side of that is, if it does come in cooler, you can see a large move upward, because the market is already a little nervous about the job report that came out a couple weeks ago. And so if the CPI report wipes those fears away and it comes in much lower, you're going to see the markets rally. So this morning is going to be a very telltale sign of where's the market's going to go today, but also probably for the next couple of weeks, if not month. And Is it going up? Is it going down? So we will see what happens here. Another thing about January too is that a lot of times companies naturally raise their prices, so they may hold prices throughout the year, or maybe raise it in the middle of the year. We have high inflation like we did last year, and then they keep those prices and they actually raise it in January naturally. It's a very natural time to raise prices. So you have a lot of companies that did that, and so you may see some of that get picked up in the CPI report as well. So we'll see. This morning will be a big telltale. So anyway, that's it for this morning. Good luck this week.